Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. November was an excellent month for stocks. The S&P 500 appreciated by nearly 10%. Our defensive stance has not changed though. We believe the long-term average price-to-earnings ratio for the S&P 500 is about 16 or 17. The market valuation was starting to approach that level, but after the bounce in November, we are back to a price-to-earnings ratio of 19. It's difficult to get excited about buying stocks at this valuation when we appear to be in the late stages of the economic cycle. Look at the weakness over the past 2 months in the price of oil as an example of what's happening in the underlying economy. The largest stocks in the S&P 500 have carried the returns this year. It might surprise you how extreme this has been. This table lists the 3-month periods that the S&P 500 has most outperformed an equal-weighted version of the index since 1989. This means the stocks with the largest weight in the index, like Apple or Microsoft today, are doing far better than the smaller stocks in the index. The first 2 quarters of 2023 rank in the top 10 most extreme periods of the past 35 years, right up there with the height of the dot-com bubble. And so far, through the first 2 months of the 4th quarter of 2023, the outperformance would rank in the top 15 on this list as well. Why does this matter? Because everything in the financial markets goes through cycles. This level of outperformance by the largest stocks will not last forever, and the historic data shows that's the case. After periods of large outperformance by the biggest stocks, over the next 3 years, investors would be better off owning an equal weight version of the index rather than the market cap weighted version. This tells us that stock selection is going to be valuable through at least 2026 in order to generate good returns. We're mindful of current valuation because economic trends still look weak. One of the components of the economy that has not turned negative yet has been employment, but we are seeing some employment components continue to deteriorate. This chart looks at the number of people that have been unemployed for at least 15 weeks and asks if the number of people that have been unemployed for this longer period of time is higher or lower than the previous year. When there is a double-digit % increase in the number of people unemployed for 15 weeks or more, it tends to mark the start of a recession, and we have reached that level today. We pay close attention to risk because of the importance of minimizing drawdowns for our clients during market declines. This chart highlights that point well. If someone is 20 or 30 years old and just starting their career, they can withstand a large decline in their financial portfolio because the bulk of the contributions to their accounts still lies in the future. However, the farther into one's life and career, the more crucial it becomes to keep drawdowns contained. This is because the bulk of one's contributions to an investment portfolio have already been made. Our target is to keep drawdowns in client accounts to less than 20%. This is why we advocate for a balanced portfolio that protects capital first and then grows in purchasing power over time by avoiding common mistakes such as chasing a hot area of the market. We're still adding new positions into our clients' stock portfolios, but the emphasis is on defense and minimizing downside. In November, we bought 4 new stocks, all in either the consumer staples or healthcare sectors. These companies on average have a free cash flow yield that is 50% higher than the S&P 500, a price-to-earnings ratio that is 1/3 cheaper than the market, and a dividend yield that is more than twice as high as the index. It doesn't guarantee outperformance or a positive outcome, but we think these sectors are the better areas to add while we watch for a better entry point in the cyclical sectors. For the S&P 500, a free cash flow yield of 5% or a price-to-earnings ratio of about 15 would be when stocks look more broadly attractive. We hope that gives you a sense of how we're viewing the stock market today. If you have any questions, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.